we are for good 7. I am only by 0.36. Today I want to present about the cases for Greenfields. Greenfields is a French company producing processed vegetable founded in 1970 by Louis Chandon and started as a small can vegetable company producing mushroom followed by washing, cutting, and packing of vegetables. Greenfields hold leading position in the processed vegetable market in Europe and elsewhere. The company's fruit and vegetable business is based on three technologies which are canned, frozen, and fresh, ready to use. Mr. Kandan is a marketing manager, has more than 20 years of experience in the aqua fruit industry within Greenfields. Mr. Kandan wants to ensure steady growth in his revenue and rely on the force of organic sales growth, combined with a recent acquisition policy which enabled him to diversify his organization location. In this case, shows that Mr. Kanda is not able to understand the write-down of goodwill value and impairment of goodwill can be considered as sending a negative signal to the family and other investors. Besides that, how the WACC that Greenfields used in 2018 to evaluate investment projects of goodwill impairment testing of acquisition in the local market and abroad.
Assalamualaikum and hi. I'd like to quickly introduce myself. I am Suzana Bettino and my metric number is S52277. Today, I would like to present the first issue for this company is whether or not the significance of goodwill impairment testing is accurate. It happens because of two factors, which is write down the goodwill value and acquisitions in emerging another country. First, for write-down of the goodwill value, in this case, goodwill value has declined, sending a negative signal to the company and others investors. The manager concludes that loss happens when a company invests considerable funds in acquisitions with uncertain profitability, or the acquired entities were purchased at an excessively high price. Second, for acquisitions in emerging another country like Russia and Ukraine, since initial recognition, the company hopes to manage the challenges of calculating goodwill. Not only that, since acquisitions in emerging countries present multiple discount rate calculation challenges, such as the availability of statistical data and risk assessment, the company has highlighted the difficulty in calculating the appropriate discount rate to use in goodwill impairment testing. Also, emerging market data can be challenging to work with due to significant data gaps, biased data, and outdated or incorrect numbers, which may lead to making misguided investment decisions. So, the investment in emerging countries gives some discount rate issue with calculation. Typically, the discount rate formula must be used in practice as the WACC to calculate it. Next, I move on to the ethical dilemma. Ethical dilemma for this issue is whether the WACC based on France is also applicable to Russia and Ukraine. Under IAS 36, the recoverable amount is defined as the higher of the fair value and the value in use of the goodwill. Value in use is the present value of the future cash flow expected to be derived from the asset to be impaired, and its calculation includes an estimate of the future cash flow that the entity expects to derive from asset and estimate of the discount rate. The discount rate reflects current market assessment of the time value of money and risk specific to the asset for which the future cash flow estimate has not been adjusted. In practice, the WACC is the most common discount factor when companies calculate the recoverable amount of an asset or cash generating unit (CGU). So, the dilemma starts when the country risk appropriate or not to be used in the discount rate and whether the WACC based on France is also applicable to Russia and Ukraine. In this case, they already mentioned that there are different types of risk and they consider the risk to be calculated.
Hi and Assalamualaikum. My name is Nur Ain Farha binti Muhammad Azmi and my matric number is S50361. For position in this issue, which is WACC based in France is appropriate to determine the value of impairment of goodwill in emerging country. And second, WACC based in France is not appropriate to determine the value of impairment of goodwill in emerging countries. The WACC reflect Greenfields overall financing costs and thus the expected minimum rate of return for the provider of capital. Every year, they estimate the WACC, which is also the discount rate they use for goodwill impairment testing of their acquisition in Europe and everywhere else. For acquisition in emerging countries, a risk adjustment may take place by adding a spread called the country risk premium to the WACC determined for Europe. In addition, in emerging countries, the market has limited capacity which relate to a country's domestic credit markets, the size of its equity, bond markets, the number of listed companies, and trading volume and liquidity. Finally, emerging market data can be challenging to work with due to significant data gaps, biased data, and outdated or incorrect numbers which may lead to making misguided investment decisions. Next, WACC based in France is not appropriate to determine the value of impairment of goodwill in emerging countries. The great potential of investment in emerging market must be balanced against the potential risk. Indeed, companies that operate in emerging markets are exposed to a series of risks not faced by mature market companies. For example, foreign exchange risk. An investor who makes foreign investment has exchange rate risk, which can suffer financial consequences. This risk occurs when a financial transaction is denominated in a currency other than that of investor-based currency. Second, political risk is the risk that a host country will make political decisions that will have a negative impact on an international investor. Negative political action can range from extremely damaging, such as widespread destruction caused by revolution, to those for a more financial nature, such as the passing of law that restrict the movement of capital. Next, emerging country risk may also include high level of inflation, macroeconomic volatility, capital controls, regulatory change, poorly defined or enforced contract and investor rights, lax country control and corruption. Lastly, foreign currency. They estimate future cash flow used in the discount rate DCF to determine the value in use are required to estimate in the currency in which they will be generated. As a consequence, the discount rate should be reflect all the currency-specific risks to which a value in use is exposed. For example, it may generate cash flow in two different currencies. For the purpose of an impairment test for that value in use, it will be necessary to discount the two different currency cash flow stream using two separate determine discount rate that incorporate the risk associated with each of those currency. The present value will be then translate back into the entity functional currency using the spot rate as at the date of the impairment test.
Assalamualaikum, my name is Wan Ali Firdaus bin Muhammad. S50400 is my matric number. Okay, next for the alternative position, if WACC based in France is appropriate to determine the value of impairment of goodwill in emerging countries. Okay, a country risk premium into the company's WACC improves the discounted cash flow. So this will ensure that an appropriate discount rate is applied when using nominal figures to discount the company's future cash flow. And also, accounting risk premium should be selected that fits with the overall picture of the company and the economy. However, the weakness of WACC in practical application are also generally recognized, especially in emerging economies. But difference in risk and a lack of understanding how emerging stock market returns are influenced by developed markets, as well as lack of reliable long-term historical market data, and these are the factors that make WACC calculation in emerging countries a complex and time-consuming exercise.
Hi everyone, I'm Aristine, matric number S50280. For suggestion, first, to improve the WACC, hire expert professionals like accountants, financial analysts, or consultants to calculate the WACC that is related to the country. We suggest that companies use the WACC to calculate Europe and Russia because in this case, the company use the WACC from French. Besides that, we want to improve the reliability and accuracy of WACC to determine the impairment for goodwill. Second, apply the CAPM, the entity incremental borrowing rates and other market borrowing rates. This rate must be adjusted to reflect the way that the market would assess the specific risk association with the asset estimate cash flow, and to exclude risks that are not relevant to the asset estimate cash flow or for which the estimate cash flow had been adjusted. Consideration should be given to risks such as country risk, currency risk, and price risk. It allows investors to take into consideration the risk premium and systematic risk of investment, while it eliminating unsystematic risk. This makes the model a superior choice over other models that are appraising risk investment. This model is also widely used due to its simplicity of users and accuracy. Next, accounting standard. First, IAS 36, impairment of assets. If the market value decreases and below historic cost, impairment must be recognized by taking a charge to net income to bring it down to its fair market value. An increase in the fair market values not be accounted for in the financial statement. Second, IFRS 3 business combination requires that upon completion of a business combination are accounted for using the acquisition method, which generally require asset and liability acquired must be recorded at their acquisition date. Second issue is Mr. Clowdon worries about the value of goodwill of recent acquisition and report in the group consideration balance sheet at every year end. However, he was not able to understand why should take the test impairment for goodwill. Why this value was written down in the group consolidation balance sheet. Ethical dilemma is whether Greenfields should recognize impairment of goodwill. According IFRS 3, Greenfield acquire business or obtain control in diversified geography location to ensure steady growth in its revenue. In this case, according to the IAS 36, goodwill acquired in business combination should be subject to test the impairment annually and recognize it, but it is not amortized. Greenfield tests the goodwill for impairment and should recognize the impairment loss when the carry amount of the goodwill is more than the recovery amount. On the other hand, IAS 36 requires that the recovery amount is determined as the higher of the fair value less cost to sell and value in use.
The position process for Greenfields to recognize impairment for goodwill. The goodwill arising on acquisition of subsidiary is subject to annual impairment review. This is because to ensure that the asset or goodwill is not being overstated in the financial statement. Goodwill is a special asset or a type of intangible asset. and that it cannot be revalued. So any impairment loss will automatically be charged against income. Goodwill is not deemed to be systematically consumed or worked out, thus there is no requirement for amortization. For the cost, it is difficult to clarify the complex accounting model about goodwill impairment testing to non-specialists in their organization. Goodwill impairment testing is a complex area of financial reporting that entails careful judgment. The impairment testing of goodwill is frequently considered as a crucial judgment and a key area of estimate accurately in preparing financial statements is best supervised. This is available in order to ensure the consistency of outcome, which must be based on practical assumption for business case and valuation parameter. Next, determining fair value has always been up as well as a science, and different aspects will legitimately arrive at different valuation. Furthermore, it is possible to manipulate the allocation matrix in order to prevent failing the impairment test. If management recognize the impairment of goodwill for the purpose of manipulating financial information that is harmful for the shareholder, the manager will understand impairment in order to overstate goodwill due to capital market modification. Furthermore, manager may prevent or minimize impairment in order to show higher profit, with the expectation that no impairment will occur in the future. According to the study of Shah, Jha and Jha 2013, managers are likely to overstand goodwill to maximize their own interest and their bonus. Besides that, based on article on Ginger and No 2006, they expect that firms that have a change in manager are more likely to recognize a higher initial amount of goodwill impairment, so that the new manager can report higher earnings in the future.
Alright. If Greenfields should not recognize impairment of goodwill, the pros will be maintain value of goodwill, because if Greenfields recognize the impairment of goodwill, it will cause the decline of the value of the goodwill. So if this company recognize the impairment for the goodwill, will not always attract much attention from the investor, and this only shows the overpay for another business and doesn't see the expected return. Okay, next, for the cons, if Greenfield does not recognize the impairment of the goodwill, it will easily overstate its value, since goodwill is an intangible asset for the company. Although we treat it as a normal asset and amortizing it, it does not help us to give a clear picture about its value. For example, when Greenfield in the purchase price allocation process of for acquisition, other business will overstate the value of goodwill by understating the fair values of the net asset required. In other purpose, to overstate goodwill related the capital market motivation, that is, manager could have incentive to affect the short-term value of the stock market price of the stock price, and to maximize their own interest rather than shareholder. Also, the second cons is that manager who provide biased and unreliable information with the goal to maximize their own interest based on goodwill are initially recognized or purchase price allocation, because in IS3 it requires that the acquiring entity allocates the purchase price to the acquired assets and assume liability as their reasonable value. So the excess of the purchase price over the fair value of the net asset acquired is then recognized as goodwill. Those who have the ability to influence financial reporting and also can manipulate financial information to provide the unreliable information to maximize their own interests, such as the purchase price allocation process that are used to allocate a higher proportion of the purchase price of the goodwill.
Next, the alternative position for this issue is to reintroduce of goodwill amortization. Reintroduce the goodwill of amortization would be appropriate because it reasonably reflects the consumption of the economic resource required in the business combination over time and can be applied in a way that achieve an adequate level of verification and reliability and improvement in the area of disclosure requirement. Amortization will release some of the burden from the impairment test and possibly make it easier to execute. A systematic reduction in carrying amount of acquired goodwill will also resolve the concern of stakeholders who believe it is overstated. If goodwill amortization is reintroduced, some of the current issue with recognition goodwill could be addressed by enabling goodwill acquired in a business combination to be subsumed in goodwill. When recognition of goodwill acquired in a business combination was introduced as a consequence of the introduction of the impairment only approach. In addition, amortization for goodwill could be more consistent with the accounting requirement for most other non-current assets.
I will continue for the last part for this issue, which is decide. For this issue, our opinion is Greenfields should recognize impairment of goodwill. Greenfields compliance of disclosure requirements in any accounting standard will result in better predictions of the overall Greenfields performance and keep investors and team users aware of the fund's material concerns. Compliance with accounting standards improves transparency, consistency, standardization, uniformity, and comparability, which in turn improve the quality in group users' decisions and help in efficient resource distribution. According to the research by Khairi Faiza Khairi and Nur Hidayah Laili 2012, disclosure will refer to the mandatory requirements in the IAS 36 impairment of assets that makes it easier to make investment decisions. The new goodwill and accounting should provide group users with enhanced information with which to assess the value, allowing them to assess future profitability and cash flow. Compliance on the standard related to goodwill impairment, financial report users will gain understanding of the expectation about the asset itself. According to the research by the NVIA 2005, through the IAS 36 will lead to record impairment goodwill which are aligned with the firm's underlying economic that is beneficial to users of accounting information. That's all from us. I will finish out by saying thank you for your attention.